Welcome to Tuesday, August 2026. Right now, couples in the UK are fleeing to Scandinavia for their summer weddings, and McDonald's franchisees are basically fighting their own corporate headquarters over the price of a small fry.
Yeah, and at the exact same time, you have Amazon spending $220 billion just to ensure it survives the end of the decade.
Yeah.
It is a wildly fractured picture.
It really is. Looking at the current stack of market data, geopolitical moves, and corporate earnings, the global economy is presenting some truly bizarre paradoxes. They are all symptoms of an economy being pulled apart by these invisible gravitational forces. So our mission today is to break down exactly how these large-scale global mechanisms, from rare coordinated currency interventions to artificial intelligence budgets that rival the GDP of small nations, are directly altering the choices you make every day.
Right, we are talking about impacts reaching right down to the cost of your fast food burger and the sheer logistics of planning a family event. But the most pressing market mover this week is actually happening on the global geopolitical stage, specifically regarding the flow of energy and physical goods.
Right, the Middle East supply gridlock. Treasury Secretary Scott Bessent just signaled a major policy shift regarding that exact issue, didn't he?
He did. He hinted that a deal to reopen the Strait of Hormuz could happen as early as today or Wednesday. And, the immediate market reaction was swift. U.S. crude oil futures dropped right below $70 a barrel. The market is aggressively pricing in the release of hundreds of commercial ships that are currently just stuck in the Persian Gulf.
But oil is only half the story there. We tend to think of the strait solely in terms of crude, but if you look at the cargo manifest, this gridlock involves vessels carrying essential global inputs like liquid fertilizer, refined petroleum products, and vital industrial gases. Exactly. The prospect of freedom of movement for these ships, which might potentially even involve a controversial toll system managed by Iran, presents this crucial relief valve for wholesale commodity prices that have been, quite frankly, artificially elevated all year long.
And that macro gridlock out in the Gulf translates into a very gritty, localized human consequence on the ground. Ever since the conflict severely disrupted those initial supplies and drove up costs at the pump, UK petrol stations have been hit with this escalating wave of fuel theft. The raw numbers show a story of genuine desperation.
The surge is pretty staggering. We're looking at a 20% jump in thefts.
Which means roughly 194,000 pounds, or about 260,000 US dollars, is being stolen every single day. That is over 108,000 liters of fuel just disappearing daily across the UK. There is a station owner in the Midlands, Shailesh Parekh, who loses the equivalent of $53,000 a year to theft. He pointed out that he has more CCTV cameras per square foot than Birmingham Airport, but it simply does not matter. Well, the industry's proposed solution to this is fascinating from a technological standpoint, even if it does raise some serious efficacy questions. A company called Forecourt Eye is partnering with FaceWatch to offer free facial recognition software to 2,000 retailers by the autumn.
But if having more cameras than an international airport doesn't work, why would facial recognition change anything? The thief simply smiles for the camera on their way out. When I look at that technological fix, I see a fundamental disconnect from the economic reality here. Cameras do not deter people who simply cannot afford the fuel in the first place.
It is definitely not organized crime pulling off an elaborate heist. These are often people who fill up their tanks and then claim they have no means to pay, primarily because the basic cost of commuting has completely outstripped their wages.
And adding to that tension, the UK's Competition and Markets Authority is actively investigating whether some major supermarkets artificially inflated their profit margins during the initial supply crisis. So when consumers feel squeezed at the pump, whether by geopolitics or corporate opportunism, that financial pressure doesn't just vanish. It immediately reroutes how and where they're willing to spend whatever cash they have left.
And that squeeze on household necessities forces a very rapid change in consumer behavior. It is creating what we are seeing as a highly bifurcated market. People are suddenly scrutinizing everyday purchases that used to be automatic, and we see this vividly in the fast food sector. McDonald's just reported their U.S. earnings, and despite their massive scale, foot traffic to their domestic restaurants has fallen.
The pressure was actually significant enough that they just replaced the head of their U.S. business, bringing in Skye Anderson to accelerate performance. But fast food is supposed to act as the economy's primary shock absorber. When times get tough, you trade down from casual dining to fast food. If the shock absorber itself gets too expensive to maintain, the consumer's engine starts to rattle.
And McDonald's corporate tried to implement a fix for that rattling engine by pushing an under $3 value menu to bring alienated people back through the doors. But the friction here lies in the mechanical design of franchise economics. Corporate headquarters doesn't actually set the prices at the local register.
Right, because McDonald's U.S. restaurants are predominantly operated by independent franchisees. So while corporate designs this grand value strategy, the local owners control their own pricing to protect their individual margins.
Exactly. Because the $3 parameter was loose, only 60 to 65% of the system adopted the value menu as intended. In some locations, franchisees actually raised prices on high-margin items, like small fries, just to offset the discount they were being pressured to take elsewhere on the menu.
So the cost of a small fry becomes the literal battleground between a global corporate strategy and a local business owner's survival. And it isn't just the food industry feeling this pullback. Nike was just downgraded by JP Morgan this week, largely due to a $1 billion revenue drag in China as consumers globally pull back on discretionary spending.
Yet the paradox here is that consumers are not completely broke. They haven't stopped spending entirely. They're just becoming ruthless hunters for specific value. For example, Wayfair's stock just jumped over 25% after hitting $301 million in free cash flow.
Which, for anyone unfamiliar, is the actual cash left over after a company pays all its operating expenses and capital investments. It's the ultimate measure of financial health. And this was Wayfair's best quarter for it since 2020.
And they are successfully stealing market share from legacy brick-and-mortar stores. Meanwhile, if you look at entertainment, the new film, Spider-Man, Brand New Day just raked in $927 million globally for its opening weekend. That makes it the second biggest opening ever.
So the capital is still out there, but the bar to capture it has been raised astronomically. Consumers will gleefully spend nearly $1 billion in a weekend on a culturally relevant entertainment experience, or funnel their cash to an online retailer offering extreme convenience. But they categorically refuse to accept a poorly executed $3 fast food promotion.
The consumer is demanding an exceptionally high return on their investment right now, whether that return is caloric, practical, or emotional.
It makes complete sense. If you are tightening your belt, you aren't going to waste money on a mediocre burger or overpriced local goods. You're going to stay home and look for guaranteed value. Which is why platforms like ClarinARatio.com are having such a moment right now. If you are allocating your remaining budget carefully, you can find financial candy, brain candy, and classic audiobooks at ClarinARatio.com. It is a fantastic way to capture premium educational and entertainment value without the premium price tag. But all of this consumer budgeting leads us to the most jarring contrast of the day. While the average person is agonizing over the price of French fries, big tech and big pharma are operating on an entirely different financial planet.
They really are. They are deploying cash at a pace that defies historical precedent. The scale of the spending is almost difficult to comprehend without breaking down the mechanisms. Amazon shares just hit an all-time high, pushing its market cap over the $3 trillion threshold.
And their Q2 numbers show Amazon Web Services, their cloud division, hitting $42.2 billion in revenue. But the most vital detail from this earnings report isn't the revenue generated, it's the capital expenditure, or CapEx.
Right. CEO Andy Jassy just hiked their 2024 CapEx estimate from $200 billion up to $220 billion.
Which is a staggering number. If you are an investor looking at Amazon right now, you have to ask yourself, is this $220 billion capital expenditure a moat that protects your shares, or is it just a bonfire of cash? Because capital expenditure isn't just operating costs, it is money spent on hard physical assets.
It is land, it's chips, it's infrastructure. Jassy explicitly stated that the demand they are seeing for 2026, 2027, and even 2028 is already outstripping their physical capacity to build these data centers. Building them requires purchasing massive tracts of land, securing exclusive connections to local power grids, and building industrial cooling towers.
But this invites serious analytical skepticism. Is a $220 billion bet truly a sign of guaranteed, bankable future revenue? Or are we watching an AI arms race where tech giants are simply too terrified of being left behind to care about the return on investment? Especially when you note that right as Amazon hit this peak valuation, Jeff Bezos filed to sell 15 million shares, pulling about $4.1 billion off the table.
The arms race analogy is entirely apt. because we are seeing the exact same defensive spending mechanism play out in the pharmaceutical industry. Merck just hiked their revenue outlook, driven heavily by their blockbuster cancer drug Keytruda, which brought in $8.37 billion this quarter alone.
However, their actual net profits took a severe hit. And the reason lies in their own capital deployment. They spent billions acquiring two biotech companies, Terns and Cidara. They are willingly absorbing multi-billion-dollar acquisition charges just to buy future survival at a massive premium today.
Exactly, because Keytruda's patent expires in 2028. Once that happens, cheap generics flood the market, and that $8 billion quarterly revenue stream effectively evaporates.
So just like Amazon is spending hundreds of billions to ensure they aren't obsolete in the AI era, Merck is scrambling to secure entirely new revenue streams before their golden goose goes off patent. The underlying mechanism is identical across both sectors. Dominant, cash-rich companies leveraging their reserves to frantically build a bridge over an impending technological or patent cliff.
But all of this frantic corporate spending, whether it is Amazon buying acres of servers or Merck absorbing entire biotech pipelines, relies on one fundamental input, the cost of borrowing money. And right now, the global cost of money is severely straining the international financial system.
Which brings us to a historic and rather alarming move in the global currency markets. For the first time since 2011, the United States and Japan conducted a coordinated intervention to stop the Japanese yen from sliding past a 40-year low. A coordinated intervention of this scale is a glaring red flashing light on the dashboard of the global economy.
It is. Tokyo sold roughly $59 billion from their foreign reserves just to buy yen on the open market and prop up its value. And the mechanics of how and why this intervention works are critical to unpack.
Right, because by dumping $59 billion worth of U.S. reserves onto the market to buy their own currency, Japan is artificially sucking up the available supply of yen. That engineered scarcity forces its value to go up. But why intervene now? Why are they so terrified of a weak yen?
Because a rapidly crashing currency acts like a vacuum in the Asian export market. If Japanese goods suddenly become vastly cheaper on the global stage because their money is weak, it forces neighboring manufacturing nations like China and South Korea to aggressively devalue their own currencies just to stay competitive in international trade.
So that dynamic risks triggering a destabilizing currency war across the entire region, injecting intense volatility into global supply lines and pricing. But wait, hold on. If Japan is intervening to save their currency, we need to look at what they are actually doing domestically. Japan just raised its benchmark interest rate to 1%, which is their highest level since 1995. If a country raises its interest rates, shouldn't that attract investors and naturally make their currency stronger?
In a vacuum, yes. But the answer lies in the disparity between the two nations. While 1% is historically high for modern Japan, the U.S. Federal Reserve benchmark is sitting at a range of 3.50 to 3.75%.
So global capital acts like water flowing downhill. It naturally moves toward the higher yield. Institutional investors pull money out of Japanese assets and pour it into U.S. assets to capture that higher 3.5% return, and that constant outflow of capital creates an immense downward pressure on the yen.
Regardless of Japan's domestic rate hikes, exactly.
Which introduces this incredible irony into our own domestic policy. We have Philadelphia Fed President Anna Paulson stating this week that she voted to hold U.S. rates steady because she needs to fight core inflation, which is currently sitting at 3.3%. She explicitly wants to keep the cost of borrowing elevated domestically to cool the American economy.
But by maintaining those high U.S. interest rates, the dollar stays incredibly strong against the yen. So the U.S. Treasury actually has to step in, utilizing coordinated foreign exchange interventions to fight the gravitational pull of its own central bank's interest rate policy.
We are actively manipulating foreign exchange markets to counteract the global side effects of our domestic inflation fight. It perfectly illustrates the impossible balancing act central banks face. A policy meant to cool inflation in Philadelphia ends up risking a currency war in East Asia.
And while macroeconomic policymakers are pulling levers to manipulate interest rates and currency reserves, local businesses are spending thousands of dollars trying to fight the actual physical climate.
We always think of climate change in terms of rising sea levels or macro weather patterns, but the first place consumers actually feel is in the hidden climate premium added to everyday events. We can bring this macro data straight back down to earth, specifically to a sweltering glass church in West Yorkshire.
With summer temperatures repeatedly breaking 30 degrees Celsius across the UK, the local wedding industry is facing an entirely new economic reality. The average UK wedding costs around £20,000, or roughly $26,000. But that budget is suddenly being hit with massive, hidden infrastructural costs.
Because the direct physical impacts are completely reshaping the business models of these rural and historic venues, when a severe heat wave hits, venues are forced to rent premium commercial air conditioning units at surge pricing just to keep guests from passing out.
And more consequentially for the bottom line, the primary profit engine for these venues, which is alcohol sales, is plummeting. Guests sitting in unair-conditioned barns or glass structures in 30-degree heat are exclusively drinking tap water to stay hydrated, rather than paying premium prices for cocktails or wine.
So the infrastructure of the event is buckling, and even the supply chain for basic wedding aesthetics is breaking down. The growing window for popular British wedding flowers like peonies and roses has shrunk from 2 months down to just 2 weeks because of the extreme heat and slow germination.
Florists are having to source from 3 times as many growers just to secure enough stems for a single weekend. That logistical nightmare pushes delivery and sourcing costs up by an extra £200, or about $260 per wedding.
The climate is fundamentally shifting the required business infrastructure. Venues are quickly realizing they must physically adapt their properties or lose their lucrative summer bookings entirely. We are seeing historic UK venues hire French companies to build custom orangeries equipped with specialized air-to-air heat pumps and heavy-duty ventilation systems.
They were doing this specifically because the French have decades more experience constructing event buildings designed to mitigate extreme summer heat. And as a result of all this friction, the calendar itself is shifting.
The traditional peak summer season is becoming a liability. The shoulder season of October is essentially the new peak summer for weddings. Even more fascinating is how this alters global travel patterns. British couples are abandoning the traditional Mediterranean destinations.
Right, instead of flying their families to France or Italy, they are booking destination weddings in Scandinavia, places like Denmark and Norway, specifically to escape the heat. They're perfectly willing to pay a premium just to guarantee their guests won't be sweltering in an unair-conditioned church.
When we pull all of these separate threads together, today's economic landscape clearly doesn't fit into a single, neat narrative box. We are observing distinct, powerful pressures moving in entirely different directions.
Geopolitical tensions in the Middle East are dictating the viability of local petrol stations. Technological paradigm shifts are forcing corporations to spend hundreds of billions of dollars just to maintain their future market position against obsolescence. And climatic changes are reshaping something as fundamentally human as where, when, and how people choose to get married.
And it all comes back to those invisible gravitational forces we talked about at the start. Every single story we looked at today involves a hidden friction premium. It is the extra $260 required to source out-of-season peonies because the local harvest window collapsed. It is the $220 billion Amazon has to spend just to keep the lights on for the AI revolution.
It's the geopolitical toll of navigating the Strait of Hormuz, or the $59 billion required to stop a currency from collapsing under the weight of global interest rates.
We are entering an era where almost everything carries an invisible premium just to maintain basic stability. So, the question I want to leave you with is this. Looking at your own life and your own business, what invisible premium are you paying today without even realizing it? Thank you for spending part of your Tuesday with us, and we will catch you on our next exploration of the markets.